Money. Money.
Today, I'm going to stick to my own arena and talk about mortgages. Why? Because the interest rates are still low. And yes, again, we hit another historical low. So reasons you might be thinking of for refinancing. Lowering interest rates, that's the obvious common thought process or the thought of refinancing. And you may have heard before, you want to drop 1% or more to make sense in refinancing. It really matters in how much you're changing your amortization schedule. So the shorter term you've been in, the shorter time frame you've been in your current amortization schedule, the less that you're making up for re-amortizing the loan over a full another 30 years. So what is the answer of what that time frame is? It's really easy. You just make sure that your mortgage professional runs a report that shows you exactly where you're at in your amortization schedule today, where you will be based on how long you plan on keeping the property. So if you're going to keep the home for another 5 years, look at where you'd be, your principal balance 5 years from today in your current amortization schedule. The key is to compare it with your new amortization schedule. And if you've got a payment savings, just assume you're making the exact same payment because that's comparing apples to apples and which one pays off sooner. That will tell you without a question if it makes sense for you to refinance based on lowering that rate. Now, lowering payment as well. I just gave you an example here talking about lowering rate, lowering payment, and applying that towards principal. But really, there's a lot of things that you can do with that lower mortgage payment. You want to be strategic in where you're putting that money. Again, having a mortgage professional that can analyze and run the numbers for you on what makes most sense, whether you're going to pay off other debt that costs you a higher interest rate, whether you're going to pay off other debt where you're not getting an interest write-off, where majority of the time on your mortgage, you're going to get your interest write-off. So just look at what you're doing with that lower payment. Getting out of an adjustable rate mortgage. Now, a lot of you may still be on adjustable rate mortgages. Why? When we've had such low interest rates and we've seen appreciation come back in properties for quite a while. The reason why is because if you were on, let's say, a 5-year adjustable rate mortgage or a 7-year or 10-year, you're fixed for that period of time. And then after the initial adjustment, after the initial fixed period, then it starts adjusting every year. Well, most likely you're on the most common adjustable index, which is your 12-month LIBOR index. And if you take a look at what the index has done, I mean, it's just really, really low. So even though your interest rate's getting adjusted, you could see your interest rate being adjusted lower than what you originally started out with. So it's kind of hard to refinance. But here's what I would caution for you. Eventually the rates will go up. So that rate is going to be fixed for another 12 months. And then it's going to be based again on what the current 12-month LIBOR or whatever LIBOR, the index that you're currently on right now. Again, it's just most common is the 12-month LIBOR. It's going to adjust based on that for another 12 months. Once the interest rates go up, the LIBOR, how your adjustable rate mortgage is going to be increasing, is going to go up as well, and it's going to be too late for you. So if you plan on keeping the property for a longer term, getting out of an adjustable rate mortgage and a fixed rate is really good right now. Talked about lowering payments. Also, what about consolidating debt? So you can bring in bring in debt that you have on revolving credit cards now that you've seen some equity in your property. You do want to talk to your accountant on that. Make sure you're making the right decisions or understand how the interest write-off is going to work, because if you're paying off consolidating debt and cash out, that portion of it most likely would not be an interest write-off on that. So again, you want to make sure you're looking at the numbers and understand how that's going to calculate out for you. Remove someone else off of the loan. You know, that's another reason you see people refinancing. Getting rid of mortgage insurance is another reason. But what I would caution for you on mortgage insurance, if you're on an FHA, depending on when you got the loan, the mortgage insurance is you had to hold on to it for minimum 5 years. Now it's for the life of the loan. So you need to check with your servicer on that. But on conventional financing, minimum 24 months to 3 months before you can go in and get a new appraisal. So why refinance out of a conventional rate mortgage if you've had it for 3-4 years and you don't need to actually refinance to get rid of that mortgage insurance, but instead just pay for an appraisal? Now, if we're talking about lowering the rate at the same time, that's a whole nother conversation. Again, just running the numbers will let you know what makes most sense for you. What about consolidating first and second mortgage together? If you've taken out a HELOC, we've seen a lot of people doing that with the appreciation coming back in properties right now, doing some remodeling on the home. If you've got enough equity to pull those two together and get a nice fixed rate mortgage, that's wonderful. Shorting your term. Here again, I just want you to be cautious in looking at this and make sure you're running the numbers with your financial planner as well to see if it makes sense. You can get a smoking interest rate on a 15-year fix. You're going to get 1%, maybe even lower than that, than what you would for a 30-year fixed rate mortgage. But what would that increase in your payment due, and where could you be investing that over the long term that might see a better return for you? So again, running the numbers with your mortgage professional as well as your financial professional on what that money is going to do can really help you make the best possible decision. Now, things to consider. You have to consider how long you're going to keep the home. That's going to answer a lot of questions for you. You want to consider what your loan amount's going to be, whether you're going to finance in closing cost or not, and the overall cost of refinance. Again, just running that report to see how long it's going to take you to recover those costs. Now, tips to get ready for refinance: have your docs ready to go. Don't slow up the process. Just if it makes sense for you to do it, move forward and take advantage of it, because you don't want to miss out on these interest rates. Again, we are literally at another historical low right now. We're going to see interest rates go up. How quickly and how much is the question. But even if they were to go up just a half a percent, that's a big chunk of money that you could lose by not locking in right now. Also, you do want to make sure you're getting a good interest rate on your mortgage. Mortgage companies are going to be competitive. So to get out there and just shop a bunch of companies, I'm not telling you to do that, because everybody's going to be competitive in the market. But do get some numbers and run those to make sure you've got a good competitive quote. But make sure you're doing it same day, because interest rates change every day, sometimes multiple times throughout the day, because you don't want to be playing the rate game. And then one important thing is understand the costs associated, and understand that you have cost structures that you can choose from. Different cost structures, you can make a decision on what you want to do. Make sure you take a look at an awesome interest rate, paying some points, all the way down to doing a no closing cost loan at all, taking a higher interest rate. Multiple cost structures, you can see what makes most sense for you. And again, lock in the interest rate if it makes sense. Take advantage of it now. That's the Money Chat. And coming up next in the Money Hour, how do you invest in a low interest rate market? Conversation I'll be having with Gary Castle with Mountain Top Advisors right here on 1150 AM KKNW after this short break.